Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. This has been an extraordinary year for property in Australia. National house price growth has been phenomenal, peaking at a monthly rate of 2.8% in March. Across the year to November, national dwelling values rose 22%, made up of a 21% increase in combined capital city values and an incredible 25% lift in regional Australia. The estimated total value of Australia's residential real estate has hit a record high of $9.4 trillion, up a staggering $2.2 trillion in just 12 months. But where to now? The banks are all forecasting prices to slow significantly next year and then drop slightly in 2023. Tim Lawless is the Research Director for Asia Pacific at CoreLogic. Tim, welcome back to Fear and Greed.
Thanks, Sean. Great to be on the show again.
First things first, your numbers we use every week. We love CoreLogic simply because of the ability to turn around data so quickly. It really is quite a skill to get those numbers out basically on Sundays after Saturdays. That's a lot of work.
Absolutely. And, there's so many different data points in the housing market these days, from the auction results, which seem to get a lot of attention, but more importantly, looking at the private treaty results, the number of sales that are coming through, the rental market conditions. It's the biggest asset class in Australia by far. So it's pretty important to be reporting very timely and accurately on the market itself. So we do certainly try our hardest to make it very timely and high frequency.
You do a great job. Tim, I don't want to age you, but I have dealt with you for quite a few years, shall we just put it that way. Have you ever seen a year like this one?
Well, no, absolutely not. And in many ways, this has been the perfect storm for housing. We've seen so many different factors that have pushed housing prices to where they are at the moment. In fact, you'd have to go all the way back to the late 1980s to see a growth rate this strong. Back in the late 80s, we saw a peak rate of growth about 32%. And at the moment, we're seeing an annual rate of growth across Australia just a little bit over 22%. So it's not unprecedented. But back in 89, when we saw housing markets previously go through something similar, I was just coming out of grade 12. So I was still around, but definitely not in the role that I am now. So This has been an unprecedented level of value growth for this generation is probably a good way to describe it.
Sales volumes. Let's talk about that highest level in almost 18 years. That's 614,000 properties went up for sale across the 12 months. Why were the volumes so high this year, do you think?
There's a bunch of reasons, and part of it's the context of history. We're coming into the middle of 2019. We were seeing a turnover rate across Australia that was only about 3.5%, meaning we're only seeing about 3.5% of homes selling each year, which was a record low. So there's been a lot of pent-up demand across Australia's housing markets, which started to get unlocked way before the pandemic. Back in the middle of 2019, just after the federal election, we saw APRA loosening up their credit rules. That's when they actually relaxed their serviceability buffer. We saw interest rates coming down, and a lot of that pent-up demand started to flow into the housing market. And it was temporarily interrupted in early 2020 as the pandemic first became a thing. But then quite quickly, as we saw rates coming down further, as we saw a lot of fiscal support, as we saw households saving a lot more, which made it easier for them to access credit, we saw turnover rates got back to above average levels. The typical average over the past 10 years is about a 5.5% turnover rate. And over the past 12 months, we saw that get up to around 6% or so. So definitely not shooting the lights out, even though we haven't seen transactional activity this high for nearly 20 years. We actually saw the number of home sales back in, say, the early 2000s a bit higher than what they are now, despite the fact that there was more than 1 million fewer homes in Australia. So even though we have seen this real surge in housing sales, it is still remarkably quite a relatively low level of transactional activity considering the pace of capital gains we've seen, which I think simply reflects affordability constraints in a marketplace that have been building up for several decades across the market.
Okay, in the last couple of months, the market seems to be cooling, certainly in Sydney and Melbourne. And I mean, it's not going backwards, of course. It's just the pace of increases is lower. Whereas Brisbane and Adelaide, Canberra, I think as well, seem to be doing pretty well still. Hobart's had a great year. What is it that drives the difference between cities? Is this too stupid a question to ask, Tim? I fear it might be, but I'm going to ask anyway. So why is Sydney and Melbourne slowing, and why are some of those other capital cities, Brisbane and Adelaide, doing so well still?
It's become a real two-speed market, hasn't it? It's for a while there, we were seeing every region around the country was absolutely rocketing ahead in value growth. Sydney was recording a monthly growth rate of 3.7% back in March, and that's now reduced down to 0.9%, at least at the end of November. Melbourne moved through a recent peak rate of growth of 2.4% in March of this year. It's now back to 0.6%. Whereas, as you say, Brisbane and Adelaide are both at cyclical highs. We're seeing Brisbane housing values rising at nearly 3% month on month. Adelaide's up about 2.5%. We haven't seen growth rates through this cycle so far that high in either of those cities. Canberra also, as you say, has been quite resilient. So is Hobart, both recording growth of more than 1% month on month at the moment. So I think the reason we're seeing this slowdown comes back to two things. One is affordability. And we know that in markets like Sydney, where the dwelling value to income ratio in Sydney is up around 10 times, well, it's 10.1 now, meaning the typical household is spending about 10.1 times the gross annual household income to purchase the medium price dwelling. So affordability is clearly slowing the marketplace down in the very expensive markets. Sydney is the most obvious, Melbourne as well. But then you've also got the fact that in both of those cities, Sydney and Melbourne, we've also seen a much more substantial surge in listing numbers coming on the market, partly due to a lot of the pent-up supply that's built up through lockdowns, but also I think we're seeing a lot more vendors taking advantage of the very strong selling conditions and putting their property up for sale, which means a lot of that urgency that's been driving the market has simply dissipated in the two largest cities. Great news for buyers because they're finally getting a little bit of leverage back in those very hot markets.
Stay with me, Tim. We'll be back in a minute. I'm talking to Tim Lawless, Research Director for Asia Pacific at CoreLogic. Tim, your Best of the Best report has been released today. It looks at some of the best property performers in the last year. What surprised me somewhat was the strong performance, at the very top end at least, of units, because I just had this thought that units hadn't done anywhere near as well, but the list of the top 10 most expensive property sales is dominated by units.
Yeah, it's surprising, isn't it? Because we know that the unit market has generally underperformed quite substantially compared to the house market. In fact, the annual growth rate nationally is less than half of what it is for houses. So it is interesting to say the top 10 sales across the country, the first 4 of them are units. They're all in Sydney. The most expensive sale was the $60 million sale of 163 Castlereagh Street, which is a full top floor penthouse with quite extreme fixtures and fittings is probably a polite way to describe it.
Yep.
But then you've also got all the Barangaroo sales flowing through as well. So it looks like the top 4 sales where everything was selling over $40 million, by the way, in each of those top 4 sales is really the result of an influx of very high-end newly built stock or refurbished stock, as well as the fact that we are seeing this ongoing trend towards the demographic trend of a lot of downsizers, empty nesters, cashed up baby boomers, however you want to describe them, are driving this demand for boutique, unique, high-end apartments. And that's really shining through in these top sales over the year. We're still seeing 6 of the top 10 are houses, or at least townhomes. Most of them, again, around your blue chip suburbs of Sydney and Melbourne, like Hawthorn in Victoria or Point Piper in Sydney.
Okay, we can dream. Regional areas, they've performed particularly well. What's been the main driver across the regions this year, do you think?
Yeah, the regional markets across Australia have shown a much stronger result and a much more resilient result as well. We're not really seeing the same slowing trend across regional markets as we are across some of the major capital cities. And I think we can put this growth down to a couple of factors, one being just the demographic shift that we've been seeing a lot about. There's been a real shift in demographic trends away from the capital cities towards the regional markets as more people look to base themselves in regional Australia and fewer people from regional Australia moving back to the capital cities. So those two trends have really amplified the demand for housing across regional Australia. And a big part of that demand increase, I think, has simply been that a lot more people can work flexibly now. They can actually base themselves in a regional market and still earn, say, Sydney or Melbourne wages, we are seeing a lot more companies now formalising what you might describe as their hybrid working policies, where they are expected to be back in the office for a few days a week, but they can also work remotely a few days a week as well. So I think for that reason, we are seeing the strongest trends seem to be in those markets that are both commutable as well as livable. Mm-hmm. And sometimes you can include affordable in that basket as well, although the regional markets are becoming less and less affordable. Yeah, simply because the growth rates have been so high compared to the capital cities.
Okay, then just the other one I wanted to mention, the popularity of the lifestyle markets, the Mornington Peninsula in Victoria, Sydney's Northern Beaches, the Golden Sunshine Coast in Queensland. Do you think their popularity will continue into 2022?
I think they will. And for those reasons I just mentioned, they're commutable, so you can actually commute back into the major capitals from those markets. They offer up a lifestyle advantage from their coastal location. You can throw the Southern Highlands, for example, in there as well as not a coastal market, but more of a leafy or a tree change market. A lot of the hinterland areas are similar. But I think, again, going back to affordability, which seems to be the underlying theme across a lot of these trends at the moment, these markets are becoming very expensive and they're becoming quite exclusive. So I wouldn't be surprised if we do see a broader trend where the next best markets start to show a very strong growth rate as well. So rather than Northern Beaches in Sydney, it might be the Central Coast or getting down into Sutherland. In Melbourne, it might extend from the Mornington Peninsula out towards the Bass Coast or Southern Gippsland area, or in southeast Queensland from the Sunshine Coast up towards Gympie, Wide Bay. Those markets aren't quite as commutable, so it'll be interesting to see how popular they become simply driven by their price points.
Okay, so the ultimate question, what do you think the market will do next year?
Well, I think we're already seeing some pretty good hints on where the market might end up next year. The growth rates are across most of the capital cities are slowing down, particularly in the largest capitals. We're already seeing fixed interest rates are moving higher. We're seeing housing affordability slowing the marketplace, and a lot of speculation that we might start to see the cash rate lifting earlier than what the RBA has been forecasting as well. So chances are next year, the growth rate for housing will be remarkably lower than what it was this year. I think we'll end this year, we'll see an annual growth rate or a calendar year growth rate for nationally, probably up around the 25% mark. Next year, I wouldn't be surprised if we see Australian housing values rising maybe somewhere between 5 and 7%. So quite a remarkable slowdown from where we've been this year. But there is going to be a lot more diversity, I think. We're already seeing that in our numbers, that markets that are affordable as well as have those commutable and livable options as well, I think will become much more popular than what they have been in the past. And maybe seeing those affordable markets like Brisbane and Adelaide and Perth outperforming the major capital cities like Sydney and Melbourne, which is something we haven't seen for quite some time through previous cycles.
Tim, thank you for talking to Fear and Greed.
Always a pleasure. Thank you.
That was Tim Lawless, Research Director for Asia Pacific at CoreLogic. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.